Mr. Brown,
Mr. Willard,
Miss Clan, how are you guys?
Good. How are
doing
you?
good.
Good. I'm here. I'm ready.
Wonderful. Well, we're glad that you're with us. So
Yes. And you can hear me okay?
yes.
Loud and clear.
Good. I'm just gonna
Leslie, a little bit
close
low.
this window.
Your voice a little bit low, Leslie.
A little bit low.
Yeah.
You hear me better?
Yeah, a little bit better. Can you go up a little bit, a notch? Can you go up one more notch in terms of volume or no?
Okay. I'm up.
Okay, good.
Hear me
Sounds
better?
good.
Well,
So Jerry, you met Leslie, right? Or you spoke or you guys
We always
spoke?
spoke. Yeah,
Okay.
we spoke on the phone.
All right.
We're good. We're all friends already.
wonderful.
One big family, right?
Yeah.
That's right.
Now, do you have the way to share your screen? Correct.
Yeah,
You
I'm
see
good.
it on the stream it? Okay. Great.
Yeah, I hit present, share screen.
Okay.
Don't show these tips again.
Great.
Yeah, I got it. It's similar, very, very similar to Zoom. Right, so like you guys should be able to see my screen now or no?
No,
Not yet.
I see it. Oh, wait a minute. I do. I have to add it to your stream. Add it to the stream. There you go.
All right, good.
All right.
So
Okay.
should I keep these up or should I stop this for now then?
Whatever you'd like. I'm just going to introduce you, and so
Oh,
welcome to
okay.
the Creative Real Estate Financing Strategies podcast. We are syndicated realty and development, and we host guests who specialize in financing solutions. And today we'll focus on financing solutions presented by Family First Mortgage and Jerry Willard. Jerry has had over 20 years of experience in the mortgage industry, and he has several products that are available to buyers and investors. And you can just go on. Thanks, Jerry.
All right. Hello, everybody. Do we have is there any way to have a count of who's on or who the audience is? I don't know how it works.
I'll see them in the comments as they join.
Gotcha. Okay.
So,
All right. So basically, I wanted to talk about a couple of products that AnnieMac has that kind of differentiate us from other lenders. It's kind of special. So what's going on in the industry? If I can give a little background, I guess, right, to what's happening in the industry now and why we created these products. So right now, right, if you're a realtor, you're taking somebody out in the field, you're showing properties. How many offers? You guys are realtors, right? So how many offers have been not accepted for each of your borrowers?
well, we have several that are not coming through because of the fact that the borrowers are, they once the interest rates went up, it became a problem. So
the qualification's a problem, right?
Right.
So what we're trying to do is we're trying to take the qualification, which, listen, you still need to be qualified to do this program, but we're trying to take the contingency out of the mix. And basically what that allows you to do is present cash offers to the sellers. So right now, somebody presents an offer, it's based on a piece of paper that I gave you in literally 15, 20 minutes after I spoke to the borrower, right? I think there's a law, I remember if I remember correctly, that I actually can't ask for documents just for pre-qualification. I can get them pre-approved and kind of run them through the system. So there's a couple of ways that your clients, right, your buyers, when they get to me, there's a couple of things that we do, right? So number one, we obviously want to pull their credit, because that's one of the most important things in the loan process now, is to make sure they have a good credit score. And good doesn't mean you need to have a 740 or an 800 score or better, right? Good means you have to qualify for the loan program that we're going to put you in, because, you know, as a lender, we actually lend down to a 550 credit score through the FHA. So an FHA has a rule where from 550 to 580 credit, you need a 10% down payment. And after a 580 credit score, you can go back down to 3.5% down payment like a regular FHA loan. So we run their credit, and what the good thing is, we actually do what's called a soft pull. So we don't give them an inquiry on their credit report. So it's not a hard inquiry where it's going to hit their report as an inquiry, right? Where it could technically lower their credit score. Now you can run your report, you know, as many times as you want during a 2-week period. If you're shopping for a mortgage, it kind of counts as one inquiry. But what happens is the credit bureau companies, right? They're more data collectors than anything else. And if you've heard the stories, when somebody's credit is running, and maybe it's happened to you guys, all of a sudden you get either phone calls or emails or text messages out of the blue, you know, hey, we have this product for you. Hey, we want to talk to you. Hey, what are you doing with this? They're called trigger leads. So if I run somebody's credit, it's guaranteed that they're going to get phone calls from other companies trying to sell them a mortgage. And to not have that happen to borrowers and to kind of release them from that burden, we do a soft credit pull, right? Now, it's not an end all, but it will, because we'll get 2 scores instead of 3, but it will be the scores that we're going to use, at least for the pre-qualification, right? Now, if those scores are kind of right there, then yeah, I'll suggest we pull a hard credit, make sure that the 3rd score doesn't kick them below, and then we're good to go, or I have to talk to them about their credit, right? I have to have that other conversation about, hey, we have to do something with your credit, and then I have to tell you guys, hey, you guys need to wait, right? Because they're not lendable, they're not bankable, right? So we pull their credit. I had the conversation with them. I asked them about their job history, asked them about, you know, whatever goes into the mortgage, right? Do you own another home? Do you own any other properties? You know, what are the pitfalls that we can come up with? Are your bank statements clean? Are there any large deposits that I have to worry about, right? And large deposits are defined, you're shaking your head, right? So large deposits are defined as, you know, 1% of the purchase price on an FHA loan, and then 50% of the total gross income on a conventional loan, right? So if a couple makes $120,000 a year, to keep simple numbers, and that's $10,000 a month, if they deposit more than $5,000 in cash, we're going to question where it came from. Yeah. And they need to have a source, a credible source. It can't be mattress money, because every year we take classes on money laundering, and we're not going to allow them to just throw money in the bank to buy a house, right? We have to figure out where that money came from. And it could be from a gift. It could be from anywhere that's not cash, right? Mm-hmm. And we'll allow some cash on hand, right? You can throw $1,000, $2,000 in there, right? We're not crazy about it, but once it gets past a certain point, there is that question involved. So we get all these things done, and you know, I've been doing this 20 years, so I kind of know what my underwriters are going to accept, what they're not going to accept. I'm very in tune to the guidelines, so I'll go through it. We'll run it through a system called, you know, AnnieMac engine, right? Desktop underwriter, or Freddie Mac's loan prospector, LPA, loan prospect advisor, right? Which is their engines to get a feel for the loan transaction, but it's still not underwritten by an underwriter, right? And as a loan officer, even though I kind of run a branch up in Long Island, as a loan officer, I don't have the authority to say yes or no to a file. That's not my role, right? I'm not allowed to have that authority. So I can give you my opinion, and it's usually 99% accurate, but ultimately I don't have that decision-making authority. So I'll give you a pre-approval letter based on the information that I received from the borrowers, but it's worth the paper it's written on from who gives it to you, right? So you take that paper out, you go and shop for homes, and you make an offer, and it's a 10% down offer, and the open house has 8 bids. Are you going to win that offer with 10% down at list?
Most likely not.
Probably not. Probably not. So what we are doing is we're taking that out of the equation, right? And the burden now, or the risk now, has been placed on the seller because the mortgage process is a little onerous to get done. The burden's on the seller, and that risk is on the seller. And you, as realtors, represent the seller. So you want to do your due diligence to make sure that that seller is going to be protected. The problem is some of the people in my industry will just throw things out there, and if it sticks, it sticks, and if it doesn't, it doesn't, right? So we'll take that loan file, and instead of me giving you a pre-approval letter in 20 minutes or a half hour, we'll actually have the loan file underwritten to guidelines. An underwriter will look at it, they'll review it, they'll approve it, and we'll make sure that that loan is bankable based on what we think they're going to buy. So they're going to give me their budget, or I'm going to figure out their budget for them, which is usually the case, see how much they can borrow, because they generally don't know. So we'll see how much they can borrow, get them to that point, we'll put it through underwriting, we'll get the loan as a commitment letter. But with the Cash to Keys program, now they're approved to make cash offers because we will guarantee the mortgage process. You guys follow?
Yeah.
So now when you're submitting an offer, you're going to submit an offer with a cash offer. And I know you realtors, you want proof of funds if it's a cash offer. I get it. We'll send you a bank statement with proof of funds to show you that they have the cash to close, right?
Okay.
And we'll honor the contract dates. Now, there's a couple things with this. It's already been underwritten. So we're already ahead of the game. So I know in New York, being an attorney state, we have plenty of time to get a mortgage transaction done, right? New York doesn't, it takes 30, 45 days to close, sometimes, a little bit less, a little bit more, depending on the attorneys and who's doing what, right? But anytime that it's not an attorney state, it's generally 30 days, right? I'm doing a deal in Florida now, in Hollywood, Florida, near Coral Springs, and it's a 30-day contract, right? And they don't like to hear the word extension. So we pre-underwrite look at Anthony shaking his head, right? So we pre-underwrite the file. And so really now the only thing we need is title and appraisal. And we're going to do our due diligence on the listing. We're going to make sure that it's probably going to come in around where it is. We have our own systems in the background. But now we'll let the borrower go in with a cash offer. We'll do the mortgage in the background. If something happens during the mortgage process that disqualifies them because you have that cash offer addendum, we will close in cash, right? It's a separate entity called AnnieMac Private Equity, right? These are all the states, so you can see my screen. These are all the states that we actually do these types of loans in. And these are just some of the, responses that we've gotten, right? Because it's a very, very competitive market, and generally cash offers will win out over regular offers. Even if the cash offer is a little bit less, they will take the cash offer for that certainty, right? Knowing and take that risk out and knowing that the file will close. It's a big hassle if the seller can't close, right? They put their home on the market for a month, they gave the extension for 2 weeks, now they can't close, now they have to relist the house, find another buyer. It's a process, right? And it's a detriment and it's a cost. And it's a cost to the realtors and it's a cost to the seller. So we want to take that out of the equation. So that's Cash to Keys. Now, if you're asking about what the catch is, because there's always a catch, right? Although it's very, minimal. So what'll happen is we'll ask for, and each state is different. So I'm just going to use some round numbers for now. So we'll ask for, say, 2% of the purchase price to be held in our escrow account as a cash offer fee, right? Up front, okay? We do the mortgage. Should we close with the mortgage? And you have to use our title company, right? Although there's not really attorneys in Florida, but like in New York, you'd have to use our attorney and our title company. So as long as you use our people and we close with the mortgage, the buyer will get 100% refund of that 2% fee on the settlement statement, right? So there's literally zero cost to the buyer, okay? If something happens and we have to close cash, we're gonna charge them 1% of the purchase price, right? And then what'll happen is, because the states love to charge transfer taxes, that's kind of their way of making money. And the seller is responsible for transfer taxes. So as the seller of the home, we don't want to pay the transfer taxes on that home. So we'll have the buyer pick up the transfer taxes as well when they actually eventually buy the house from us, right? So we'll let them close. And then when they're mortgageable again, whatever that event was, whether they lost their job, whether it was a credit event, whatever that event was, once that event is fixed, then we'll let them buy the home back from us at the same exact price that we bought it for, same price that they bought it for in the beginning. That's the number, right? But we are laying out the cash, so there's a cost to that. So we will, ask for 1%, right? So that's the cash offer if you don't own a home. The second product is called Buy Now, Sell Later. This Buy Now, Sell Later is basically for those that may be relocating, who want to downsize into your neck of the woods from my neck of the woods, who have a home to sell. They're getting fed up with the market because they don't know how to time it, because if they put their house on the market, it's going to sell right away. But then now they have an offer that has to be contingent on their home sale, right? And again, that word contingency, whether it's a mortgage contingency or whether it's a home sale contingency, sellers and realtors do not like those words, right? So we take those words out of the contract completely. And we will, in essence, buy the new home that they want in cash, right? They get to move in the house. And the cost of that is the same 1% of the purchase price. However, we don't want them to make two payments. And they in essence turn into our tenant because they're moving into the house, right? But obviously, if you're going to be a tenant, there's rent to pay. Now, we don't want them covering two payments at the same time because that's a burden. So what we'll do is we'll make it a per diem rent, and it's a fixed amount based on the state you're in, either 0.6 or 0.8% of the purchase price based on the state. And that'll be prorated and then paid at the settlement when they sell their house finally, and then close on the new house with us again, right? So when they move into their new house, we give them 2 weeks to list their house to sell it. So they can move in, they can stage it pretty, they can paint it, they can make it nice. You can get top dollar for it. We'll give you 6 months to sell it, right? At whatever number you can sell it for, right? Whatever number that may be. If the 6 months passes, which hasn't happened yet, especially in this market, if the 6 months passes, we will purchase the house that they're selling from them to not burden them with the two payments, right? Because they already sold the house, albeit as a discount, because we're a business, right? But we'll purchase for it. We will purchase it, but it hasn't happened yet. We haven't bought one house that was for sale, right? Because it sells in 2 weeks, so there's no reason to buy it. So, but you guys get the time to list it, stage it, do what you want to do with it, make it pretty, take the right pictures without the clutter, and put on the market and get a good price for it. And then once that home that they're selling is in contract, they'll start the mortgage with us for the house that we bought from them, again, at the same price point that they were going to buy it for anyway. They'll pay the transfer tax going in as the buyer, and they'll close with us, right? That whole process is literally 1% of the purchase price, as long as they use our title company to do that. Does that all make sense to you guys?
Yes, it does.
Definitely.
Okay, good. All right, good. So right now, as a company, we started this 18 months ago, give or take 18 months ago.
Right.
We have over 100 people that are actually approved and in contract with cash offers. So far, 18 months, we've closed 2 with cash out of the 18 months that we've been doing this.
Okay.
Right? It's not our goal. and we're not in it to make money. It's a branch of our company that's helping the mortgage side and the sellers of properties get into homes, and it's taking the contingency out from the buyers and making them making a better offer so they're accepted easier.
Okay.
Any questions about that?
Well, so I guess when we outline the process, basically they have to get pre-approved with you, and then make an offer on a home. Then they go through and they go through the lending process on the home that they're purchasing, right?
Correct.
Okay, so and then if in fact if in fact there is a transaction where you have to buy the home back, you buy it at a discount after 6 months. Is that what we're looking at?
That's accurate. No, that's accurate. But
Okay.
again, it's never happened. But yes, that is accurate.
Okay, all right.
Right.
Well,
It's not our goal, so we want you to sell the house.
yeah, it's definitely our goal as real estate agents and brokers to go out there and sell the home at top dollar. But but we do see, as we discussed earlier, is that we see, people coming in from out of state, and they're really kind of reluctant to go forward with a purchase when they have a home that they haven't really fully committed to sell. And so, our goal is to be able to help sellers get committed to sell their current residence and move into a new one and relocate. So.
And this takes the question mark of, do I have to live with my kids, or do I have to get into a hotel while I'm buying the new house? That takes all that out of the equation, right? Because they can close with cash, we let them move in, and then you can sell the house at a comfortable pace instead of this rush craziness to get it done, and to pressure everybody on the sale to close for the purchase because you have contract dates involved and they just don't line up, Right. So again, if you, let's say we make the cash offer on the house that they're buying, they put their own house on the market at the same time, and it happens to sell, and we can coordinate the dates, then there's no harm, no foul, right? There's no cost, and they just close as a normal, regular transaction, right? And these are for conventional loans and VA, right? So we'll allow this with 100% for VA buyers. We'll allow this for conventional loans with, Fannie Mae's Home Ready or Home Possible program, 97% financing. So you can do 3% down and make a cash offer with us and be more competitive than that person that's doing 20% down because you're a cash offer.
Right.
So the whole point is we want people to, like, listen, there's not a lot of inventory, right? So cash is king, and we want people to be as competitive as possible. I feel terrible. I have a VA borrower in New York, right? They're just losing out left and right. So we're putting them in for the cash offer so they can make cash offers now, because it's not fair. It's just not fair, right? Because they more than qualify and they're going to close, but because the seller has 10 offers to choose from, why not take the one with the biggest down payment or the one with cash, right? Why should they take that risk? The less risk for the seller, the better. So if we can get them approved to make a cash offer, that's what we need to do.
Okay. Yeah, that's very helpful to know. Now, when they, I guess if I have Jason who asked a question, what gets presented to the seller's agent's attorney when they go with the all cash offer?
Right. So we'll have addendum to your offer. So you're going to place your offer like you normally do, right? But we're going to have an addendum written out with AnnieMac private equity saying that it would be a cash offer and we're going to buy the house cash, right? You're also going to get proof of funds, because we know that sellers and realtors want to see proof of funds on cash offers. So we'll give you proof of funds. It's up to $1 million on purchase prices, right? And for VA, it'll go to, the VA is 100% up to like whatever. So like we'll go up to 1.5 million, although I've never seen a VA buyer get a $1.5 million home, but they can, right? So, but you'll get the addendum with our kind of guarantee. There's also a home purchase coordinator that gets involved. So there's somebody from AnnieMac Private Equity that will coordinate, facilitate the whole process, right? So it's not just me. You have that separate company, the branch of AnnieMac Private Equity, the Cash to Keys company, going through everything and talking to all the parties involved. Like we have a big conference call on it to get everybody up to speed.
Okay, wonderful. Tony?
Yes, a question, Jerry. So how does the appraisal comes into the picture in terms of, is it done early in the process or just to secure your cash for offer sale, or is it standard?
Yeah, so what we do is we do a standard rush on the appraisal. So the appraisal cost to the borrower is like $100 more because we're gonna rush the appraisal right away. Now, if the home is listed, let's give an example, right? The home is listed for $500,000 and you have multiple offers and I have, you know, a 10% down buyer, but you're gonna have to take a cash offer on it from me. But they have to bid 550 to make the deal work, right? Make sure before we give you that cash offer addendum, we will make sure that they have the additional funds proven out to supplement the sale price that they're buying for it and the appraised value. Make sense? So we'll make sure that if they have that extra $50,000 to close on the home in cash, right? Because as you know, as a bank, we're going to lend, you know, the lower of the purchase price or the appraised value, right? So whatever offer it is that they bid on, and if they bid 550, then maybe we do a 5% down mortgage instead of a 10% down mortgage, and we give them that extra 25,000 to play with, and they have an extra 25,000 gift from mom. Whatever the case may be, we're going to prove out those funds before we allow you to make a cash offer. That makes sense? But it doesn't waive the appraisal contingency, right? It waives the mortgage contingency, but the house, obviously, for any buyer, cash or not, they want the house to appraise for what it's going to appraise for, you know, so. But if they have to go over in this market, which most do, we'll prove out the funds before we give you that cash addendum.
No, that's a very good, excellent feature to have, because now they're making the cash offer, and at the end of the day, they don't know the house is going to sell for what it's appraised for.
Right. And listen, if it appraises for a little bit higher, maybe we'll have the contract rewritten to help them out. But outside of that, it's whatever we're going to prove out first before we listen. If we're going to buy the house cash, we're going to make damn sure the buyer's approved, right? So just rest assured that because honestly, we'd rather not, right? But again, we will. So rest assured that if I say, hey, they can bid 550, the house is selling for 500, we have their assets. They will not issue the pre-approval and the cash addendum without it, right? So we'll make sure it's going to close.
Thank you.
So now,
what states do you is this product available in?
So this product is available in these states, and actually what I can do is, so I just pasted this link into our chat.
Well,
look at that. Look at that.
Yeah.
Go ahead, I'm sorry.
Yeah, is there? Can you direct some? Is it on your specific website or? Yeah.
So because I can't place a comment on. So I put in the private chat if you guys want to place a comment there.
Okay.
But yeah, they can honestly. For me, I've been doing this 20 years. If you search Jerry Willard Mortgage, you'll find me, right? And then all this is on my website. So. That's me in that ridiculous face. We have renovation loans. So you can go to all my different types of loans that we have.
Okay.
We're also a servicer. So we can close your loan and then service it. So we won't sell it off to a third party, right? Which means we're a little bit more aggressive, which is why we come on down to 550 on a FHA loan.
Now,
go ahead.
When we talked earlier, with the higher interest rates, a lot of people are staying in their homes. Now, do you have renovation loans? Could you just tell us a few?
So now with the renovation loans, so a lot of people want to stay in their homes, right? And I don't know how much this helps you guys, but it helps if you have, if you want to buy the worst house on the nicest block, these homes, these loans are perfect for you, because we'll lend you money based on the future value of the home and based on the work that you're going to do to it.
Right.
Right.
Well, some
So
investors will actually buy a home and move into it and use a 203 loan to go.
So
they would live in it for a period of time. Yeah.
Right. So as long as they're going to live in it for a year, we can do that. Right. Most of the time, if it's a true investor, Fannie Mae will actually do a renovation loan, right? And with 15% down payment. So we can do what's called a home style renovation loan, 15% down payment as a true investment property. So they don't have to play that game. They can rent it out right away. And there's really the only caveat is you can't go, your renovation budget can't be more than like 50% of the home's value, right? So you're buying a $600,000 home, or if it's going to be worth $600,000, you're gonna have $300,000 to fix up the home, or maybe that's 75%. I can get you the right answer on that. But you want to buy a foreclosure, right? You want to buy a bank-owned property, and there's no utilities on, and it's half gutted. Good. You come to us. We'll structure the loan as a 15% down payment based on the overall acquisition cost, right? Which means, just for easy numbers, you buy a home for $100,000. You want to renovate it and put $100,000 into it. Now your total cost is $200,000. You need 15% down from there, right? And now you have the cost of the renovations included in your loan amount. So as long as your investor puts that into their spreadsheet, and they can rent it for more than what they're going to pay on the mortgage, to whatever extent that they're good with their numbers, then they should do it. So long as it works for them and their return on investment, and it's okay for them, right? And the biggest return on investment is leveraging, right? And Anthony knows this. We've talked about this for years, right? The biggest way to get a biggest return on investment is to leverage whatever you can, right? And don't tell Dave Ramsey I said this, but the more you leverage, the better your return, the better your cash on cash return, right? It's just the nature of it. You put 200,000 into this house and you're getting, 2,000 a month, you're getting a 10% return, right? But you put 40,000 into the house and you're getting a $2,000 return. The math is great. You're getting 50%, right? So it's well, actually more. It's whatever the number is, right? I can't do it in my head right now, but you want to leverage. So if you have, and you can do this for quite a bit of loans, right? Like Fannie Mae will allow you to do 10 loans. So, and then if you want to do more than that, we have other investors that will do unlimited amounts, right? And for investors, we have fix and flip programs. If they want to actually flip it within 3 to 6 months, we have programs for that. And the rates will depend on credit scoring and on experience, right? So a first-time flipper will not get the same benefit in interest rate as a seasoned, this is my job flipper, right? Because we don't know. So if you've done 10 flips in the past 2 years, yeah, you're going to get premium rates. And, premium rates for that product may be 8-10%, but you're going to get premium rates. But if you're a first-time flipper, you're going to get 12-15% or whatever the number is, right? They're going to be higher. So, so we kind of have, and then if you want to buy a house, the house is fine. You don't need a renovation loan, right? You have a great accountant and you can't show your income, which is, we see this quite often, especially with, what accountants can do, writing down rental properties to zero, which they should. We have other programs where it's called a debt service coverage ratio, right? It's known as a DSCR, where as long as you have the rental income that can cover the mortgage payment 1-to-1, then we'll close. And we don't even need your employment on the application. So it's just the house, does the rent cover, and you're done, right? And again, so we just got to keep in mind, right, how how rates are based. Interest rates are all based off of risk to the lender, meaning the more documents you give me, the better the property, the occupancy of the property, the better the rate will be, right? So, 40% down, owner occupied single family will get a better rate than 20% down, two family investment, right? And that's showing documents on both of them, right? But then when you move over to the no document world, now you're not even involved with Fannie and Freddie anymore, which you don't have the government money anymore. So you're going to pay more for that. Especially with the Fed raising rates, money's not cheap anymore. So this, we're not 2 years ago when we're at the 3 and 4% interest rate level. Now we're at, 7% for regular loans, 6.5 to 7.5, depending on all the criteria. And you're in the 9-10% range for these no doc loans. So investors have to be careful, right? They have to put it into their budget, put it into their game plan, make sure it works. And if it works, then you pull the trigger, right? You don't really worry about the rate too much because you can always refinance it or sell it later on. But as long as those numbers work for you and your planning, your retirement planning or your vision, then you do it. Right? I'm not going to tell you what to do or how to do it. I'm going to give you what the numbers are, and you got to make that decision. So, but the renovation loans, the good thing is we actually service those loans. So, we handle the draws. So when you close on a renovation loan, and a lot of lenders, like my previous lender, we would close on a renovation loan and we would sell it off to a correspondent lender, like whoever, Caliber or Plaza, whoever buying those loans at the time. It would take a month and a half to get to them. They'd have to put it in their system. So, contractors didn't get money for 2 months. And they're sitting there waiting for money to show up so they can get reimbursed for the work that they did. And now you have a home buyer who's moved in with half a kitchen, or maybe not moved in yet, but you have half a kitchen going on and no bathroom, and you can't do anything with the house, and you're waiting for money. So because we actually manage the draws, when they need money for the draw, and we'll let you do draws in stages, right? But when they need money for the draw, we'll send the inspector out and we'll get you money in 2 to 3 days because we'll get it out to you. And, we'll have the check double endorsed because we don't want one person to run off with it. So both contractor and buyer have to agree, both sign, and then they get it, deposit the check.
Okay.
So that's a good thing about our renovation loans. And then if you go over to my website, I have this really cool website where we can give you discounts on a bunch of different things, between flowers and gifts, tickets and attraction. You can get 10% off of football, 10% off of NBA. You can go to Disney and get, discounts off of Disney, beauty rest, insurance, whatever's on here, right? You can see my cash to keys offer, and I will give you a $500 discount off of closing costs, right? If you come through me for your crew on here. So that's awesome. So we got to put my website out there. And that's at the top of my website, and it's called my Jerry's Perk Plan, Jerry's Perks. So if I go to my website, this is me, and then you just go to the end here, which is Jerry's Perks, and you'll get to it.
Okay. Now, with the renovation loans, you said that what do borrowers need in order to to obtain a renovation loan from you? Right.
So, and it's funny you say that because it's all transparent on my website, right? So for a 203K, so there's two 203K loans. One's a regular 203K. That's the FHA renovation loan. That's the most popular one because that's the easiest one or the least, I guess, burdensome one to do. So people say, right? Where the minimum credit score is a 600, debt to income ratio, you can go up to a 55 for a debt to income ratio. You need a HUD consultant. They have to go to the house. They have to check out, make sure the contractor's bid is close to what they think it's going to cost because we don't want anybody getting ripped off. The repairs are a minimum of $5,000, but it could be up to whatever number that qualifies, right? So this says unlimited, but it's unlimited to whatever qualifications are. It's only for private primary residences, right? So again, if you guys want to do the house hacks, that's fine, but you have to be there for a year. before you can move out and do another one. And they will not allow, you can't have two FHA loans at the same time. So if you want to do the house hack of moving in and then moving out, we're okay with that, right? But you do have to refinance this one into a regular loan, get rid of the FHA loan on the house that you just bought. This way you can do another FHA loan to get into the new house, right? Or you just do a regular loan to get into the new house and not an FHA. So you're not allowed two FHA loans. Okay. This is 1 to 4 families in condominiums. Then there's a limited, if you have less than $30,000, $35,000 in repairs, you just have to turn the utilities on, paint, and put down carpet. We could do a limited 203K, which is a streamlined process, right? So we don't need a HUD consultant, which takes $800 and a couple of weeks out of the mix. And then we can close, pretty quickly. You have the Fannie Mae home style, which is the one I was telling you, which is good for the investments. This is not, we can do for investments only. I'm sorry, investments as well.
Okay.
For home style loans.
Okay, so the home style loan, I think it looked at, was it up to 35,000? What was it?
That's up to 35,000 is the limited 203K.
Okay. All right.
Right. So that's the 203K light, right? It's the easier one of the two. But it gives you some flexibilities, right? You can have a 600 credit score and a 55 debt to income ratio, where for the conventional one, you need a 620 credit score. And this AUS approved means that AUS is automated underwriting system. That means it's got to be run through our Fannie Mae engine and it's got to be approved, which generally will require a 45 debt to income ratio on a renovation loan. Fannie Mae does allow up to 50, but it depends on the criteria, right? With a 620 credit score, you're probably going to be at a 43 or 45 debt to income ratio.
Okay.
So question. Let's see if I'm muted. Okay. So Jerry, question regarding, we are working with end buyers and of course as investors. How is there any program that you have for people who are participating in auctions, like online auctions or in-person auction at the courthouse?
So that would be, the online auctions are a little tricky because I know you have to put usually 10% down at the time of when you win the bid, and then they give you like 30 days to close, right, or something to that nature.
Yep.
So that would be, I would have to have the loan ready to go to facilitate that, right? They won't allow like a cash offer on a bank-owned property. Makes sense because they don't know what the inside looks like. Generally, you can't get in. The utilities are turned off. Well, in my state, the utilities are turned off. I don't know if they do that in Florida because you don't really need to winterize a property in Florida, right? But in New York, you do. So we generally don't allow it on REO properties. But if I have the buyer in and pre-approved, so we could do a commitment letter pre-approval without a cash offer. It would take a couple of days. Usually it's 2 to 4 days to get the pre-approval underwritten and approved. And then when you're at the auction, it would have to be for the mortgage, right? So the seller or the auction house would have to allow to have a mortgage done to have that possible. Did that answer your question or no? Because I know auction houses usually want cash offers, but
some still have that 30-day window, which is possible for you to slip in with the mortgage. Others, you definitely want to be all cash. So the all cash program wouldn't work for that then because you need all that pre-qualification anyway, period.
Well, it's not the pre-qualification, it's the fact that it's an REO. We won't allow it on REOs.
Got you.
So auctions are a little difficult, right? So they're a little more difficult for these types of programs, right? So if you want to do a regular loan and they're fine with it, then that's all good all day.
Good.
Or a renovation loan, right? That's fine too.
Understood.
So, and then just so you guys know, right? Like this is kind of my day all day, these charts, right? I'll give these guys a plug, MBS Live. They're a fantastic website, right? Like you will learn so much if you're in something like this, but I literally have this up on one side of my screen and the other side is all my other stuff because I want to see what the market's doing, right? Red is not good, obviously, right? Red is bad. Green is good. So you always want to see green. But you can't always see green because then it'd be a one-way market, right? It just doesn't happen like that. So, but I want to show you a quick chart, right? Somebody actually posted this chart, which I thought was really cool. This is the 10-year treasury market from December, right? Looks like a year and a half ago, give or take, right? So we were down in the very low, like look at that 1.3, 1.4 range. If you see, this is where the treasury market is.
Mm-hmm.
And this is December of 21, right? So as we started coming out of COVID, right? This is a very big spike in May of 22. And then we came back down and kind of settled, and then another big spike, right? In September of 22. And now we've been in this kind of sideways trading range, literally from October on.
Mm-hmm.
This is the trend line, right? So over the last, from over the last, say, week and a half, 2 weeks, this has been kind of a brutal trend for us because that's a very straight line going up for mortgage rates. But in the overall grand scheme of things, we do see rates dropping, right? We do see it coming back in line. Now, if we break above this trend line, then forget what I just said. And then we're going to 8% rates, right? So hopefully we don't, but we've kind of been in this pattern. And, you know, this is all done with, you know, debt ceiling talks are coming into play now, and the political environment has a lot to do with it, and the Fed raising rates had a lot to do with it, but they finally are going on pause. So we do see it leveling out, right? And hopefully coming down later on towards the end of the year. So you're going to hear a phrase. A lot of people say you want to, you know, marry the house and date the rate. And that's because if you find the house that you like, you know, the best time to buy the house was yesterday or a year ago, right? Similar to life insurance, right? The best time to get life insurance was yesterday. Now you're a day older, it's going to cost you more, right? So the best time to buy a house is yesterday or a year ago, because with appreciation, it's going to be worth more. So if you love the house, maybe you marry the house, maybe you date the rate, but you want to be comfortable with it, because if rates don't come down, and I'm not saying that they are 100% are coming down, because nobody knows, but that's the trend. And that's what the projections are with the brain surgeons of the world that are in my business, right? We all think it's going to come down into the low to mid fives. That low to mid five number will get sellers off the fence to be able to sell their home. They don't want to go from a 3% to a 7% rate, but they'll go from 3 to 5 to make their life better, into a better school district, or get that extra bedroom now because it's not as much of a burden. Inventory will come back on the market. Home prices will start leveling out, and you'll see a lot more action, right? But until rates kind of settle out and come down a little bit, I think we're going to be in this low inventory, you know, 10 offer phase, which is why we need to get people approved to make cash offers, which makes them stronger to the sellers.
And with the approval process time, how long normally is that?
I mean, we can, if I'm honest, most lenders are on, you know, 24-hour approvals because of the lack of, it's not like lenders are, you know, so busy right now, right? You know, I got 5 people looking at one house, only one's going to get it. So, you know, so that's only one deal to underwrite. So, I mean, 20 days is pretty normal. 20, 30 days is a very normal turn time now. Whether we pre-approve them or not, it's about a normal turn time, right? The longest time in this, getting the appraisal done, which, you know, we have an appraisal panel that we've hired directly. So that's usually a couple of days. The title report's a couple of days. We have to just put everything together in our system, make sure it works. After that, you know, so 20, 30 days is pretty normal.
Okay. All right.
Start to close, right? And that's you know, I've seen it go further depending on the borrower. And I've seen it go further depending on attorneys, depending on title reports. You know, there's a whole bunch of issues that we don't have control of. But in general, 20 to 30 days.
Right. Now, is there a difference? You mentioned some of the loan products, basically. We were talking about that jumbo products. So, you know, I think you mentioned that there was a cap of 1.5 for the for the cash for keys. Was that
Cash, yeah. So cash, 2 keys.
cash keys?
Yeah, and I know you guys know cash for keys quite well, right? Because those are deep blue. I know, I saw that, but yeah, it's cash 2 keys. Yeah, on the VA side, there's a cap, right? At 1.5, and on the conventional side, there's a cap at 1. So we're gonna cap you there, and that's strictly for the cash to keys. I mean, we can do jumbos to $2-3 million like that. It's not like we can't do them, right? But they're not very prevalent because most of those people have the cash already, to be honest. So it's funny, the higher the purchase price, the easier for them to just buy it in cash anyway, and it's their own money, and they're talking to their private client guy at Wells Fargo or wherever JP Morgan, right? Wherever they have their money at that point. But yeah, we could do jumbo loans, right? So you have $1.5 million purchase, which doesn't qualify for cash or keys, but they want to borrow $1 million. That's a jumbo loan. It's over Fannie Mae's limits. We're good with that all day, and we're competitive.
Okay. Yeah, and then you don't normally see VA loans that are that very large, but it's particularly in Florida, because you have a lot of retirees that come in and use.
Yeah.
So.
In Long Island, where I live, they're all over the place. Yeah.
Yeah. So, do you have any questions, Jerry?
Yeah, sure. So, Jerry, I'm doing land development, right? So,
correct.
Do you have a specific program for land acquisition as well as the ground up construction?
So we have a ground up construction. We have finish your question. I'm sorry.
I'm saying, even though that's a standard product for most lenders anyway, right?
Yeah, ground up construction. We get you vetted, and I'll give you a good word, but we'll get you vetted as a builder, and then you could do ground up construction, right, from start to finish. It's the normal construction loan, interest only during the construction phase, paying what you use type of loan, right? We also can do construction of permanent loans if you want the burden to be on the buyer, where you'd unfortunately have to deal with. So some builders don't like it, right? I don't know how your take is on it, but it's similar to the 203K loan, but it's for a full, it's a one-time close or a two-time close, depending on the buyer, where it would be a dual endorsed check, and you'd have to go in phases, right? But then you have none of the burden of the interest payments or any payments, because that's on the buyer. Right. So, but we'd want to keep it to a schedule because we don't want them to, go past a certain 12 months or 18 months, depending on how big the build is.
Definitely.
But we'll give you some time to do that.
In acquisition, is that a part of the ground up construction too, or that's separate? Like doing acquisition?
No, land acquisition is part of it. We want to see it all in one shot. There's not many lenders that will just do land acquisition. There's maybe 2. That'll do it, and it's they're not that pretty, but I guess they're out there, and I can find one for you. But for the most part, we want you to do it at the same time, right? So if you want to do land acquisition and a build, you would do it both at the same time, and then we can figure out if you want to do tract homes, right? If you want to build, if you want to buy 5 acres and put 20 homes on that, right? That's something that we can we'll discuss that separately, but that's something we can probably do for you also. If you need it.
Yeah, definitely. We'll definitely be calling.
Right. Now, with the buyer and the construction to perm, is the rate locked in? Or I know 2008, 2000, they I did a lot of construction to perm loans, and so I just wanted to
yeah. So the rate is locked in because. Okay. The worst thing is, and we lock people, probably as early as in the application process as feasible, because we don't want that volatility during the application process, right? I don't want to be the one that says, hey, we had you qualify for 6%, but we never locked you in. A month later, it's 7%. Now you don't qualify. That you won't get, right? I'd rather have the reverse conversation of, hey, we locked you in at 7%. Yeah, raise a 6, and I'll see what I could do. Right, but at least you're getting 7%, right? You're committed, and listen, we have a float down option if we have to. Not that my secondary department's going to love this, but we'll figure something out, right? Because we don't want to lose the buyer, right? So we'll figure something out if rates go down that far. But we don't want it to go in reverse, right? We don't want people counting on us and not coming through because we didn't do our job and advise the borrower to lock in when we thought it was the right time. Or, I mean, I give rate updates all the time. You see the screens I'm looking at, they get automatic, hey, maybe it's a good time, maybe it's not. Although I'll never tell somebody not to lock in, because if they want to lock in, that's their choice and they're going to lock in. I'll just give them my opinion of the market based on what I see that day. Does that make sense? But to answer your question, once they close, that's it. That rate's not changing, right? Okay. Unless it's an adjustable rate mortgage and it's going to change, years down the line. We're not going to mess with them during the construction phase, right? Or during, the loan, right? So once it's closed, it's closed.
Okay.
And these loans are normally 12-month, 24-month loans, or?
It's on the build, right? It's generally not less than 12, but if it's an extravagant build, we'll extend it out. Yeah. So it all depends on the build.
Yeah, I like the
How long does it take to build?
Right now, you're up to about 8 months, to be honest. From literally getting the permit, because what happens is that utility companies are so busy with all the development going on, they can't get to bring new power to the properties or to that neighborhood fast enough, right? Because it's subbed out by the utility company. So they have a backlog, and if there's a disaster like recently last year, all of them went down south to help out, and so nobody's doing work locally.
Right. So then, like on yours, just for your example, we would do 12-month builds, and then there's always, there's always extensions. Obviously, things happen, right? If you're showing us that, the utility companies are just not showing up, or another disaster happens and they're out in Texas somewhere because everybody went there, we'll figure that piece out, right? We're not gonna, there'll probably be a cost to it, but there's not going to be some major catastrophe where we're going to make you repay the loan, in that time frame.
Perfect.
We'll let you finish, so.
Definitely.
Right.
What else? Any other questions for me?
Let me check the chat.
Yep. Don't see any other questions, but we appreciate you coming on to provide information on the loan products, and we look forward to being able to work with you and have our clients work with you in the future. I'll put up your website here, but certainly if you want to, do you have information that you can put on the like an end card or anything that you want us to post? We can do that.
Okay.
So
yeah, I'll get you my info. Right. The best thing is, if listen, my cell phone's always the best way to call me. Tony knows that. Like, you can just call my cell phone. If I don't answer, it's because I'm doing something like this or I'm a little bit busy, but I'll always get back. Or send me a text, right? You go on my website, you do, book time. It's linked to my calendar, so it knows when I'm busy and when I'm not, and it'll let you book time with me. So however you guys want to communicate, it's fine by me. And either myself and you got an email from my assistant, Christine. Either one of us will absolutely get back to you and let you know where we are with everything.
Okay, wonderful. Wonderful. Well, we appreciate the information, and I'm certain that any investors and buyers and so forth really they can utilize your services, and these programs are really a great opportunity for us as real estate agents to be able to help our sellers, but also to help buyers move in, and relocate from other locations. So
100%. We're actually having a real estate, we're having a mastermind class. So what we do real quick is we invite realtors from across the country onto one big go-to webinar. So last one we had 500 realtors on, and it's a panel of realtors explaining to other realtors how they use the Cash the Keys and how to promote it, how to talk about it, how to get people to use it. right?
Okay.
And how it's helped them in their business. So you can hear from somebody in Texas on how they use cash to keys in Vermont, like, or whatever the case may be. It's how it works, right? And it's just best practices on how to use the program. So I can send you that invite also, and you're more than welcome to come on. It's about an hour GoToWebinar, similar to what we did now, but it's all about cash to keys, and then all the people on there are real estate experts that use the program.
Okay. And, a lot of our clients are real estate investors. And so, any webinars and so forth, that you have related to any of the products you have for real estate investors would be a great opportunity also.
I can send you everything.
And our clients being real estate investors, they have buyers that are normal buyers that are buying their properties. And that's the reason why we need some products for buyers.
So when their buyers have a cash offer now, they're secured. And the best way to get to an investor's heart is not through their stomach, but it's through their pocket. So, right, if we get their buyers approved for cash, they're done. They know it's going to close, guaranteed.
Okay.
All right.
Well,
Appreciate it, Jerry. As always, you always come true for us. You're definitely one of the go-to guys in this industry, and just a good friend to have.
would you be able to do?
Really,
Yeah. Would you be able to do maybe a presentation on construction loans?
absolutely.
Okay.
Yeah, I'll do a presentation. I'll do a slideshow.
Okay.
Sing and dance, whatever you guys need.
Wonderful. We have a lot of development going on here in Florida because that.
Should do.
And so, I think even Tony was looking at 5 tracts of land, 5 lots they wanted to put houses on. So, we really need.
Tony, you'll be calling me tomorrow?
Oh, actually tonight, as a matter of fact, tonight,
Oh, look, Tony's texting me now. Look at that. Okay.
Yes, we will.
So yeah, we can help out. I'll put a presentation together on whatever you guys are looking to do. No
Okay.
worries.
Wonderful. Thank you.
All right. Thank you guys. Really appreciate it. It was fun.
Thank you. I appreciate it. Bye.
Bye-bye.